Welcome to The Explainer. Today, we are talking about the AI boom. But instead of just asking the usual question, is it a bubble? We're going to look at this whole thing through a completely different lens by asking three really critical questions.
First up, the big one everyone's thinking about. Is this whole AI craze with these insane valuations for real? Or are we just watching another classic bubble inflate, getting ready to pop, just like all the others?
But here's where it gets interesting. What if this bubble is different? I mean, fundamentally different. What if it's not even supposed to pop? Could this thing actually be designed to just keep on growing, totally defying everything we learned from past crashes? And that leads to the final, and maybe the scariest question. If this whole thing does fall apart, are we just talking about a bad day for the NASDAQ? Or are we talking about a shockwave so big it could take the entire global economy down with it? Well, the wild theory we're exploring today says the answer to every single one of those questions is a big, loud yes. Yes, we're in a bubble. Yes, it's actually designed not to pop. And yes, if it fails, it would be absolutely catastrophic. And the reason why connects everything from NVIDIA's stock price all the way to the heart of American national strategy. Okay, so to really get our heads around this AI bubble, we have to start somewhere completely different. We need to look at the gigantic economic problem that AI is supposedly being built to solve. And here it is. This is the villain of our story, the U.S. national debt. $38 trillion. I mean, it's a number so huge you can't even really wrap your head around it. And the problem is, there's no normal, easy way to pay it back. It's more than just a number. It's a massive national vulnerability. The easiest way to think about it is with your own money. Let's say you have a huge mortgage. What's the only real way out? You've got to go get a much higher paying job, right? Well, for a country, that job is its GDP. The US doesn't just need its economy to grow a little bit. It needs it to grow at an absolutely explosive rate to even begin to deal with this debt. And that is exactly where AI comes into the picture. The whole argument we're looking at today is that this AI boom is not just another tech revolution. It's a deliberate economic plan. It's a Hail Mary pass designed to solve that $38 trillion problem. So what's the game plan? Well, according to this theory, it's a pretty straightforward four-step process. First, you pour trillions of dollars into AI. That spending alone gives a nice short-term boost to GDP. Step 2, all that investment creates a huge long-term boom in productivity. Step 3, that productivity boom leads to deflation, which means prices start to fall. And finally, step 4, when you have higher growth and fallen prices, the real value of that giant debt starts to shrink. Now, that word productivity can sound kind of abstract, but here's a really simple way to picture it. A human taxi driver, they can work, 12, maybe 14 hours a day max. But a self-driving taxi, it can work 24/7. It practically doubles the productivity of that one car. Now, just imagine that same effect happening in every single industry all at once. And here's the magic trick. That huge productivity boom leads to deflation. If it costs Waymo half as much to give you a ride, they can charge you less. When that starts happening everywhere, the value of every single dollar you have actually goes up. And when your money is worth more, that $38 trillion debt suddenly feels a whole lot smaller. So why AI? Why not just dump all this money into healthcare or manufacturing? Because those industries, they tend to grow in a straight line, pretty predictably. AI is seen as the only thing on the planet that has the potential for that crazy, exponential hockey stick growth, the kind of growth that could actually be fast enough to outrun the debt. But, of course, none of this is happening in a quiet little bubble. It's all playing out inside a massive geopolitical pressure cooker, a high-stakes, winner-take-all AI arms race between the US and China. I mean, just look at this timeline. In just 10 years, the money being spent on AI by these two countries is expected to increase by nearly 10 times. That's not just a couple of companies trying to outdo each other. That is a state-sponsored race for the future of the entire global economy. And the soldiers in this new kind of war, they're not just companies. They're basically instruments of national strategy. These foundational tech companies, NVIDIA, Google, Microsoft, TSMC, they're the modern-day equivalent of aircraft carriers. When they win, the country wins. And the prize for winning this thing, it's total domination. Whichever country ends up controlling the foundational AI stack gets to export its technology, its rules, and its influence to the rest of the world. They lock in economic power for generations. Okay, So, knowing all of that, the giant debt crisis, the high-stakes global race, how should we look at all the typical signs of a bubble? You hear the skeptics, and they raise a really good point. They see stuff like NVIDIA investing in a startup, and then that startup immediately uses the cash to buy chips from NVIDIA. And they say, come on, that's just a shell game. You're just moving money in a circle to pump up the stock price. And, it's a classic sign of a bubble. But the counter-argument here is that this bubble is just built differently. It's designed not to pop. Why? Well, for one, these core companies are already making tons of money. Two, they have clear public backing from their governments. And three, and this is the most important part, this whole spending spree isn't just random speculation. It's a national plan for economic survival. For the government, failure is simply not an option. And that creates the ultimate safety net. A normal bubble pops when all the private money dries up. But these tech giants, they're effectively backstopped by the government, by nations that can literally print more money if they have to. So this looks a lot less like the dot-com bust and a lot more like the bank bailouts in 2008. Only this time, they're doing it proactively, before a crash. So maybe the big takeaway is this. Asking, is it a bubble, might be the wrong question. This isn't just about the market getting a little too excited. It's a state-sponsored race for economic dominance and survival. So the only question that really matters is, in a race this important, what's the cost of coming in second place?